Good morning. I'm Casey Wagner. I'm a reporter at Blockworks, and I am joined by Alex Prager, who is the head of Connexus Labs at JP Morgan, and Konstantin Richter, who is the CEO and founder of Blockchain. Thank you guys for joining us. This panel is called Onchain Capital Formation and the Next Wave of Institutional Crypto Products. It's a lot to cover. I wanted to get right into on-chain capital. So we were talking about this talk on our prep call, kind of defining what that is. So to put into context, in 2025, if you take the whole cryptocurrency market cap, including stablecoins and RWAs, we're looking at about 4.6 trillion. In 2022, it was 2.5 trillion, and in 2020, it was around 195 billion. So we've definitely seen a massive increase. Konstantin, I want to start with you. What do you think is driving some of this movement into on-chain?
Well, yeah, I mean, maybe if I give a quick perspective on how I look at it, because we're kind of a tech company, and so we build the sort of core infrastructure for institutions, and really what that means is like the physical nodes that allow institutions to send transactions through crypto networks, pull data, and then earn yield and protect keys. And so the only reason I mention it is because what we've so what we notice a lot is that we see a lot more traditional financial institutions buying infrastructure that allows them to connect to crypto networks, submit transactions, and specifically earn yield. And so the biggest shift I've seen since really the beginning of the crypto cycle is where everything was focused about allowing people to hold and sell Bitcoin, basically. Like we enabled people to hold cryptocurrencies. And in this iteration, it's all about borrowing and lending against those cryptocurrencies. And the minute you borrow and lend, these numbers become enormous, right? Because you're creating collateral, people borrow against it, they move it in other asset classes. And that's, I think, been the biggest immediate driver of change we've seen is all these dots and ETFs and folks and treasure companies who are like, kind of, hey, let's put, I don't know, $1 billion of ETH on the balance sheet. Now you realize that, hey, if you hold a cryptocurrency like a normal currency, you need to offer yield. And there are very organic ways in cryptocurrencies to do it that are actually automatically on-chain. And so staking is a good example. Staking is when you protect the network, basically like a mini bond offering on-chain, but it's on-chain. You earn yield automatically. And we just see that become a much more important impetus for institutions.
Alex, how do you think about on-chain capital and the growth we've seen in the last few years?
Yeah, definitely. So at Connexus, we have been live since 2020 and working in the space since 2015. So many cycles have been seen, but this time I think is unlike any other that has been in the past. And so when I think about on-chain capital formation and what Konstantin mentioned as well, and from an infrastructure perspective, we really look at what is the right kind of suite, if you will, of components needed in order for us to be able to serve our clients in whichever way they want. I think we've seen a huge shift, especially in the US in the last year. And I think for us, where we really started to see a ton of explosion was around when asset managers in 2024 started launching products on public chain. And I think that was a really big catalyst for a lot of other activity, as well as the product market fit of cash on chain and other assets as well.
What do you think some of the next catalysts will be for driving more institutional demand and interest?
I think at the moment it's going to be real utility for institutional clients. And the more utility that is present on-chain in a number of different ways that Konstantin mentioned as well is when you're going to see participation rise and activity rise. And so it's really about, at this point in time, it's no longer convincing institutions and convincing players that there is something here and that there is value to be had. It's really when you can see those results and quickly, and that's what we're seeing in the market right now.
Mm. When thinking about increasing institutional demand and interest, what fundamental advantages does on-chain capital formation have over traditional markets? Konstantin, did you want to take this one first?
Yeah, I mean, I think a good, if you just look at last Friday, for example, which I don't know if you guys in crypto, you might have had some restless hours, but if you're not aware, there was an event, basically Donald Trump and China disagreeing, that triggered a 20 billion liquidation cycle very, very quickly. And I thought what was really interesting this time around is it was the largest day of liquidations in the history of crypto. I think it was 10x what FTX was like. And we're not sitting here today talking about, whoa, man, all these guys are now in jail, all this stuff blew up. We had bank runs, it didn't work. That's actually not what happened. It's actually remarkable how stable the crypto ecosystem stayed. And a lot of it is networks like Aave, for example, like the DEX infrastructure that actually exists, that still really holds up a lot of the crypto infrastructure, because we're talking about institutions, but most of the volume right now still is owned by crypto-affin sort of, gunslingers, I'm air quoting, but and so that these DEX infrastructures just automatically handled these basic liquidations and pooled liquidity from the right sources and basically automated these liquidations on chain without a disruption of the system is actually truly remarkable, right? And really an indicator that also the DEX infrastructure has evolved massively, and which we think is, again, however you define, really what DeFi is and decentralized exchanges and stuff, but this is really where the crypto story lives, right? It's the smart contracts, the software facilitating transactions and finding liquidity. And so I think that's a fantastic example of what happens when this works, that we're here today and prices just kind of went back up. Everything, well, not totally back to normal. It's just for lots of people who lost everything on Friday, but the system is sort of just back up and running.
How are you all moving your product stack to be more on-chain?
Yeah, I mean, for us, it's been, we've been really challenged because our partner base is really traditional financial institutions. And I think JP Morgan is an investor, for example, and Alex is a board observer. And so we have people and partnerships with the Citibanks, the Bank of New York, the Fidelities, the Goldman Sachses, all those different people. And so I think what's most notable is one, that they're getting actually very, very serious to look at the wallet components and key management components to hold digital assets. And so that's really the starting point. The primary is like, where do you physically, you can see they're preparing to actually hold digital assets. And then secondary, for us, the biggest selling product now is really what we call our earn stack, which is actually yield on stable tokens, for example, or yield on Bitcoin. And so, as mentioned, stable tokens specifically, since the Genius Act in the US became a really big thing, and people want to use them to also earn yield, right? And so how do you physically actually go about offering this? And now we offer connectors for that, for institutions, for example. And so we're a lot more focused on that. My sort of internal prediction is that on-chain fees will triple in the US alone next year, and it's actually pretty conservative if you look at how small the current digital asset landscape is compared to, the 130 trillion, even just equity markets,
Alex, thinking about some of those use cases, what do you see as the fundamental advantages of on-chain capital formation versus traditional capital markets?
Yeah, and this is an area that I spend probably almost all my time in, because if you think about the financial markets and traditional infrastructure, they've been around a very, very long time. And so part of my job on the lab side is to work with all of our businesses and our clients to figure out what are the right use cases and what are the right products to be developing on-chain. And the really fun part about that is being able to take a look at what works today and what doesn't work. Because there are some things today that work just fine. We move trillions of dollars a day, and there are no issues. But if you think about starting at a place of on-chain, that's when you can think about, okay, now we've got programmability, we have smart contracts, we have the ability to have instantaneous settlement versus T plus 1, 2, 3, et cetera. So looking at where we can kind of rewrite, if you will, the financial ecosystem to take advantage of new technology, that is somewhere that I think becomes very compelling when you think about operational efficiencies that can be gained and new functionalities that can be had. And then on the flip side of that, it's figuring out how you can actually achieve those efficiencies while still being cognizant of legacy infrastructure. Because legacy infrastructure really underpins everything that we do today. And if you think about gaining efficiencies and creating products on the front end, you still have a ton of work to do to settle on the back end. And so it's kind of a push and pull at the moment of how do you gain the most efficiencies possible with the newer technologies at hand, while also making sure that you're making progress on the legacy infrastructure side to move that along as well. But I think, smart contract capabilities, programmability, and a lot of the on-chain ecosystem are just these net new components of a new financial infrastructure that are really exciting for us.
Are there areas where legacy systems still have an edge?
I think it depends really on the products and the asset classes, but I mean, there's still, if you think about the way that trades settle on the back end today and the amount of systems that they go through, the different counterparties that exist across the ecosystem, they're also all operating on their own infrastructure, right? They're not, they don't have the benefit of decentralized technology. So it's really pervasive across, but I think it's also something that is known across. And so we talk a lot about on-chain efficiencies, but there's also a lot of work going on from a legacy infrastructure perspective across the market.
Konstantin, do you agree? Are there areas where legacy has the edge?
Yeah, I mean, I think we're really just a tech vendor, and so what we notice the most is how complex and individual all these financial institutions run their IT stack, right? And so I think it's just fascinating how old some components of that stack are, and then there's iteration and very novel things, but as a whole, it's a really difficult system to navigate, which is probably why, I don't know, JP Morgan has, 100,000 engineers or something. It's insane numbers of people. And it's because it's a stack that basically, protects whatever, hundreds of billions, trillions of dollars of assets, has to provide KYC, AML, all the money laundering, all the tax requirements and stuff. So there's huge legal implications. And the willingness to change and take risks here by pulling out little different pieces of software and replacing them and doing it in a way where you can generate innovation is insanely complicated and complex. And so I'd say that the big question for us is actually, is AI and quantum compute going to take crypto to a level where you can generate a totally new financial stack, or do you have to iterate with the existing one? And it goes back to does crypto replace the existing financial system or become part of it, right? And so I think we see that also play out within these institutions.
We've been talking about infrastructure a lot. When it comes to onboarding more institutional clients, where does the infrastructure currently stand? What gaps still exist? Konstantin, did you want to start?
I mean, I think for us, the hardest part is, again, that these institutions are so massive also. So there's so many different parts in financial institutions. There's the custodial part, there's the trading, the wealth management, there's all these different bits, and they all have different laws and applicable rules. I think maybe to take it to a political level, like with the Clarity Act and in the US, there's this really big debate if a company like Coinbase is actually allowed to offer all the services they do, which actually in a traditional financial industry, you wouldn't be allowed, right? There's normally these different sort of Chinese walls between, prime brokerage and custody and consumer banking and stuff. And so I think what's interesting is really to kind of see if the existing crypto infrastructure with the rules that are coming is going to get broken up a little bit to reflect more what traditional financial markets look like. But yeah.
Yeah. I think from our side, an area that we spend a lot of time on in thinking about how to make onboarding and other, KYC and AML and all these different policies fit for on-chain is identity and on-chain identity. And so, thinking about what can be done there is something that we've been looking at for the last 5+ years. How can verifiable credentials be used to make this more efficient? How can privacy-preserving on-chain identity help with the continued activity on-chain and not having to go back each time, right, for KYC and AML for the next piece, of the next leg of the trade is really important. And so there are incredible tools out there today across the ecosystem that are used for on-chain activity. But what I think is a huge focus point is how can we get some of the existing requirements kind of fit for on-chain, if you will, and privacy is another one that we think about a lot. So privacy preserving identity, how do you make sure that, investors today and the privacy that they have and want to continue to have, can remain there. And so solving for some of those off-chain pieces and figuring out how to get some of them on-chain, I think is a huge enabler.
Konstantin, I see you nodding. How are you all thinking about privacy and compliance?
Yeah, I mean, I think it's such a great point. I think if you think about the whole identity play, that's kind of really where it's at, right? Because I'm not a financial guy, and when I think about really what banks do is basically they match value with identity, right? And then they make sure that that's correct. And so the whole identity thing is just massive. And so really how you go about defining that and how you move that on chain in an encrypted way is going to be really interesting. Again, I don't want to, but I do think it's important to understand that, again, AI is going to be so important in the identity management because we need these. The fun thing here is when you look at online identity, is what AI is going to do. It's going to really, really suck. Because it's going to create, it's going to take identity of people, it's going to make everything sortable. It's going to be really, really hard to have privacy in a world that's fully AI enabled. And so actually, that's where crypto and financial institutions will become much more lookalike, because really the only way to protect yourself from AI becoming sort of totally centralized in terms of everything is with cryptography. Right, and so we kind of say that AI is the big centralizer and crypto is the big decentralizer. And so from an identity perspective, that'll be really, really interesting and a lot more important, because if you look at the attention economy, I'd say that probably didn't go too well. We really monetize the worst instincts of people, and the way identities are monetized in the attention economy isn't fantastic. And so we want to make sure that for the financial economy, we do a better job here.
I want to zoom out for a minute. Looking ahead, we'll say 5 years, what percentage of capital formation do you think happens on-chain versus traditional rails? Konstantin, did you want to start?
I mean, I have to say 100%. Because I feel like 5 years, I just feel like, again, quantum compute, AI, and crypto together, I think is going to break traditional development timelines. And so I do think in 5 years' time, with agentic agents for payments and everything, you'd be foolish not to be on a digital rail.
Do you think we'll need to see a big catalyst to get there, or you think the tech is just going to keep improving and adoption will kind of follow?
Yeah, crypto was created on the premise that the current free market global capitalistic structure doesn't lead to good outcomes, and I think it's questionable. Let's see what the world looks like in 5 years.
Alex, what's your take?
I think 5 years in this environment is very different from 5 years in any other environment. If you asked me this question in 2020, my answer would be totally wrong today in 2025. But if I think about where we are today, I'm not as bullish as Konstantin. I don't think it's going to be 100, but I want to say over 50%. And the reason I say that is I think some areas and asset classes will probably be fully there, and others will take more time. I think in terms of catalysts, right, the amount of on-chain cash options that are coming into view and into clarity are really big enablers of that as well. I think having crypto and RWAs on chain is something that I think we've seen now for a while, but now the cash component to be able to actually have DVP and instantaneous settlement on chain, to me, is the huge catalyst to see more and more change over the coming years.
We just have a minute left, and I want to do another prediction question. So as a reminder, current on-chain capital is 4.6 trillion. Give me a number 5 years from now.
Again, I don't know, 250 trillion is my bet. Because, if you, I think the total financial market is a quadrillion or something. It's a massive number.
Right.
And I think that's an important point to make, is when we say financial institutions are coming to crypto, people don't understand the scale. Like the scale of flow is just enormous. Like, I mean, crypto is tiny. You know, we're like at 3% or something of where the global markets are at. And so I think it's just, yeah, it's going to be exponential for sure.
We'll come back in 5 years and we're going to get these predictions on the.
In 5 years, I'm not going to talk to any of you guys.
Yeah,
I'll be in
so
my
it's all
bunker.
gonna be agents everywhere.
Exactly.
I think if we're at 4 trillion today, I want to say 50 to 100 trillion, maybe closer to 100.
Okay. I'll see you all in 2030.
Yeah. That's right.
We'll have a conversation.
Our AIs will have this conversation.
My agent will talk to your agent.
That's right.
Definitely. Yeah. Thank you guys so much. Thank you for joining us. Great discussion.
Thank you.